The CBN's decision to raise monetary policy rate to 24.75% is likely to have broader implications for financial markets, investors' sentiments, and economic expectations. At the end of its two-day meeting yesterday, the CBN raised the interest rate by 200 basis points to 24.75%. While the CBN retained the liquidity ratio at 30%, it however jacked up the CRR to 45%. According to the CBN Governor, Mr. Olayemi Cardoso, this is targeted at taming inflation. My colleague Ademola Lawrence was there and filed in this report.
The committee's decisions are as follows.
The CBN Governor says the new interest rate is a leap from the 22.7% announced by the MPC about a month ago and the second rate hike by the current committee. Mr. Cardoso also announced the retention of the cash reserve ratio of deposit money banks at 45%.
Raise the MPR by 200 basis points to 24.75 from 22.75%. 2. Adjust the asymmetric corridor around the MPR at plus 100 to minus 300 basis points. These considerations underscore the importance of the CBN's commitment to the price stability mandate and the need to urgently bring inflation under control to ensure that purchasing power of ordinary Nigerians is restored in the short to medium term.
On the rising inflation, the CBN Governor assured that it will significantly drop by December, and he also acknowledged the effort of law enforcement agency in tackling issues of illegal forex transactions.
On this note, members commended the ongoing efforts of the federal government towards addressing food insecurity. Some of these measures include the provision of various palliatives, release of grains from the strategic reserves. The law enforcement agencies, of course, are now looking into those transactions that are, as far as we're concerned, not valid to be paid.
The next Monetary Policy Committee meeting will be in the month of May. Ademola Lawrence, TVC News, Abuja.
Well, that was it yesterday after the two-day meeting. But what are the likely implications of this move on the economy? Let's get talking. And I'm being joined by the Chief Investment Officer at AfriInvest West Africa, Mr. Robert Omotunde. It's good to see you. It's been a while.
Thank you very much. I'm glad to be here.
200 basis points is what we saw after 400 basis points just a few weeks ago. And it stands at 24.75%. Now, I think I should ask the question this way. What were you expecting? And with what has happened, what does it mean for the real sector?
Well, I think that most market watchers expected the central bank to take the rate up again. Because I think Dr. Cardoso did not mince word in speaking to the fact that he wants to get interest rates high up there in order to curb inflation. And that brings us to that question, why are we doing all of this? We are doing it because we want to put a rein on inflation. But are we doing it the right way? The first question to ask, Mr. Cardoso did not start the tightening measure of the central bank. It started with Mr. Godwin Emefiele. You know, to be specific, we started the hiking spree since May 2022. And we have continuously hiked month in, month out, and we are here at the level that we have found ourselves.
Winning on inflation.
As a matter of fact, the more we are hiking, the more inflation keeps climbing up. Should we not step back and ask ourselves some questions, right? Because I know I'm an economist, and don't get me wrong, I'm an economist. What economic principle says is that inflation is always and everywhere a monetary phenomenon. And most times when we try to curb inflation, we target interest rate with the understanding that the economy is normal, because there are assumptions to every economic principle. The assumption is that the economy is normal and there is a transmission mechanism between the policy rate and market rates that is effective enough to show you the result of your tweaks to monetary policy rate. That is what happens in the United States. That is what happened, with the Bank of England, the European Central Bank, Bank of Japan, most of the developed economies, because they have an effective transmission mechanism. What Dr. Cardoso is trying to do now is to ensure that it brings back, to some extent, the effectiveness of monetary policy. Don't forget, MPR lost its anchor since like 7 years ago. I would say 2016, 2017 or thereabout. That was when MPR lost its, monetary policy anchor. Why? Because at that point in time, the, SY administration of the previous central bank, government was doing, what was sort of antithetical to what market principles preach. Where we have found ourselves is where we are right now. And come to think about it, we're talking about inflation at 31.7. And we think that we need to chase that rate in order for us to be able to put a rein on inflation. I dare say that is not the way to go. And in your introductory reading, somebody was talking about the implication to private sector.
Yes.
The implication to private sector is one of the least problem that the government is setting itself up to face in the near term. Let's look at it from a debt sustainability point of view.
Yeah.
The government debt servicing cost, at some point, read as much as 99% in 2023. We are talking about a debt stock of 91 trillion. At the moment. Yes. But that is based on DMO statistics as of December. Yeah. I am very close to the market because central bank has been auctioning, DMO has been auctioning the treasury bills market, in the bonds market, and by calculation, at the minimum, they have raised close to about 6 trillion this year. So we are talking about 97 trillion. At expensive rate, by the way, they've raised at 18, 19, 21. The last one we're talking about 21.45% or thereabout, that treasury bills rates were issued. Even the long-term, relatively longer-term bonds at 10-year yield was raised at 21.5% or thereabout. Now, the implication of that is that even if you assume that the debt servicing cost on an annual basis, on what it is confirmed by the end of this year, we will be over 100 trillion in terms of debt stock. So by the time you are paying on the average between 12 to 15% on an annual to service your debt, you are paying, don't forget, ways and means have been added to it. Yeah. You are paying close to about 21 trillion on a yearly basis to service debt. And look at the budget of government. It's already made, the current statistic has already made a mess of current government budget. Government budget suggests that you expect, I think about 18 trillion naira in revenue. Yeah. Even if you concede that the government can achieve this revenue, which is very unrealistic that they'll be able to achieve it, you are saying to us now that with our debt servicing costs, given our debt stock, you're going to be having a number that is closer to a 110 or 120% debt service to revenue. And then we are raising interest rate as if, it does not have consequences on the government. It does. And the moment we keep doing this and we continue to do this, we are not trying to, we are creating a bigger problem down the line. Now, let's now face the point. When you raise interest rates, yes, do you actually solve inflation problem? Let's talk about it. Nigeria's inflation today is measured by consumer price index, yes, that has a basket of commodities that you are measuring. These basket of commodities include food. Food accounts to 50.7%. That is, over 50% of the basket is made up of food. Please, can you tell me a food item that goes up and comes down in Nigeria? So there is a consumer behavior to these things as well. Now, what is the direct implication of an MPR hike on the food prices? The one that I can think about is that, just like the Nasima, president said, the direct one you can see is that for prime borrowing companies, companies that are taking loans from the banks, because what the banks do is every time MPR goes up, they reprice upward immediately. When it goes down, it's very sticky. Yeah. They don't likely reprice downward. Yeah. But when it goes up, that is the behavioral pattern. There's something in finance, we call it behavioral finance. It's not just enough to take the principles, hook, line, and sinker, and apply. How does it fit into our own environment? The truth is that you are raising MPR. let's look at it. We started this, just look at 2023, for example, where we closed at 24%. Yes. Inflation, inflation rate or thereabout. Now, today, what are we talking about? We're talking about 31.7 from the average of 24.5% or so that we saw in 2023. Yes. What does that imply? Every time you see inflation rising up, the more we are raising MPR. Then why should you punish the people for the recklessness of government? I mean, in the previous administration,
Yes.
ways and means, clicking over
Yes,
20 trillion.
yes,
It is good that the current government is not towing that part.
Yeah.
But I'm telling you, the part we are going now, by the time their servicing cost is heavy on government, government may have no other choice than to tend to ways and means again. And it's dangerous. It's a dangerous part. So we need to sit back and really study our own transmission mechanism and how it actually fits into the model we are trying to pursue. Now, we are doing all that we need to do in order to put a rein on inflation. And then I must say kudos to the current central bank.
Yeah.
You know, some of the things we have said on this show is what they are actually
let me come in. Look,
Yes.
look at the issue of clearing the backlogs now, you know, at
Yeah.
least verified ones. That seems to be, look at what is happening to FX now. At least there's a bit of, effect of that move in that market. You want to say something
That's
about
a
that?
very good move because, we've spoken about it before, that the bulk of the activities in the foreign exchange market
Yes.
are speculative.
That's it.
Now, because they are speculative and you have now taken the bull by the horn by ensuring that, yes, you want a market-driven foreign exchange market. And that is, I must give it to Mr. Cardoso, because we've not had this in the last 10 years. So what we are seeing now is that we have a market-driven foreign exchange market. What has happened? A lot of people are dumping.
Yes.
Because those who are speculating are just thinking, oh, we don't know whether it's going to 1,000 and everybody is dumping.
Yes.
That's a good move.
Okay.
You see what I mean? It's a very good move that now needs to be supported by consistent policy initiatives that will suggest to foreign investors that when I bring my funds into Nigeria, I can easily
take it
get
back.
out. Because I know that the central bank is currently desperate for capital importation. It's good to attract capital. I mean, at some point, I think it was credited to the former central bank governor that he doesn't care about foreign investors. But now we know that Nigeria cares about foreign portfolio investment, which are, some of the low-hanging fruit by which you can support, your currency. Yes. I mean, no responsible government will leave his currency to be determined by speculators,
Yes.
But to the extent that we are approaching it from the perspective of the market, look at it. Consistently, we have even seen NAFEM window even higher than what we are, is obtainable in the parallel market. That's a good move, and I think that the government should sustain that.
Okay.
Now, why we are doing that, let's be clear that for a foreign investor, today now we talk about a yield of 27% in the treasury bills market, the short-term money market. Now, at 27% yield, which is about discount rate of 21.5% or thereabout, at 27% yield, how sufficiently can we attract foreign capital into our country? Now, that question cannot be answered until we can answer the question of how easily they can move out of the country when they come. Yes, and it's going to take time for this current government to build that confidence. They have started on the right path. They should not get discouraged. They should continue. It will take time to build that confidence. Because once they can see that if I bring in my money and I earn that 27% yield, I can easily repatriate, then they will easily be convinced to come in. Now, the other thing that comes with it is when you bring in foreign portfolio investment, you should also be ready for the consequence when they are exiting. Because when they are exiting, the consequence is that your exchange rate at 1.2, 1.3 can get as high as 1.4, 1.5, and you must be flexible enough to allow the market to price itself appropriately. Now, the moment we are doing that, confidence will be rebuilt over time. At some point, our annual flow was up to $18 billion. I dare say that if we are consistently doing that, we will gain more. We have been excluded from JP Morgan Emerging Market Bond Index since 2016, shamefully so. But now, if we continue in this path, we can get enlisted to that index again. The moment we get enlisted, more foreign portfolio investments will come in. What we should not do, however, is to sacrifice the stability of the domestic economy for attracting foreign portfolio investment. Because the way we are going, it looks like that's what we are trying to do. It's dangerous. It is dangerous.
You mentioned food.
Yes.
It takes a bulk part of our inflation, the impact of inflation on Nigerians. Now, what can be done? The CBN distributed fertilizer, made available fertilizer for about 100 billion naira. And we also see state governments, Lagos, Niger, partnering and all of that. But insecurity seems to be one of the challenges that we face along that line. How can we help? What can government do to at least address that aspect of food?
The good part is that I like that the current central bank is not delving into the realm of fiscal policy.
Yes, Everyone is focused on
what they,
so they can complement each other.
Absolutely. So the central bank should continue on its path. They should not go the way of the previous central bank, where we are doing intervention this, intervention that.
Too many.
We don't need that. Now, to the point, and it will bring me back to another point I raised, which is that when we raise interest rate, when we raise MPR, how effectively does it tackle inflation? You mentioned insecurity. Insecurity is the major reason why food prices are skyrocketing.
Yeah.
Food prices now closer to 35%, if not more. You understand? And while inflation, the headline inflation is around 31.7%. Now, the reason why we are seeing all of these prices is because people can't go to farms because of insecurity. And then the few supplies that we are able to get, the few output, they are selling for higher prices. How much of that can higher MPR address? Let's think about it. If I'm a farmer and I cannot go to farm, so instead of my output, instead of producing 10 million metric tons, I produce 7 million metric tons. And then because the food is scarce, everybody is raising the price. How does increase in MPR address that? And that's what the focal point I want the central bank to begin to focus on. Because it's easier for you to punish the economy for the recklessness of the previous government, for printing so much money, and then you have money all over the place. Money all over the place. But you cannot solve that same problem by now you are more like you are imputing more woes on the economy by raising interest rate. Now, a company that already has a facility with a bank is already advised of the repricing. Now, if that good is inelastic enough, if it's a necessity and there's not so much of them, even if there are so much and they can form a cartel that is effective enough, the next thing you see is that their prices will go higher. So it is not impossible that the higher inflation we have been seeing in recent time is also because there has been higher interest rates in recent time. So there is a need for balance, and that's what we must talk about. And I tell you, now, the impact of a higher inflation on an individual, how does it get resolved by MPR? I tell you what monetary authorities do most times is that you will hike interest rate up to a point when the base effect mathematically kicks in, and then that base effect brings down inflation. But I tell you, the prices of goods have not really gone down. In fact, they have not gone down at all.
And when things go up in Nigeria, it rarely comes down.
And that is the consumer part of it, the consumer behavior part of it that we needed to have studied.
Attitudinal change?
Yes, before. No, you see, that attitudinal change is not the job of the central bank.
Yes, it's not.
You see my point?
Yeah.
It's not the job of the central bank. But what they need to do is to study how do people behave when prices go up. What is the behavioral pattern to reversal?
Yes.
You understand? Once we can study that, and inflation in Nigeria has always been moderating on base effect. So it's always been a mathematical moderation. In the real sense, the cost of the bag of rice, have you read any time when the cost of bag of rice came down? You understand? So even when you have effectively taken interest rate up, what eventually happens is that, base effect will kick in at some point because it's consumer price index. Yes. Because you should be looking at it. How is inflation from a monetary point of view, interest rate impacting on what is real? It is real that people need to go to farm to produce food. So you can see that the only benefit we tend to see in the short term is exchange rate. How exchange rate is moderating, maybe you can begin to see the impact on some prices, the prices that are not so sticky.
Yeah.
But on the ones that are sticky, once they go up, you find it tough to get them down. So, and I dare say that raising MPR at all times is not the way to solve it. The way to solve it, it's not necessarily to raise MPR. And what do you need to do?
Let's talk about that as we wrap up. Let's talk about what you need to do.
What you need to do as a central bank when you are looking at some of these factors is that do not forget, as you are raising MPR, for example, the debt crisis on the side of government is also getting higher. Government is going to need to make more money. And if they don't make more money, they can print more money, as a matter of fact, to meet their debt obligation in the local currency. That also has inflationary implication in the future. So what the central bank needs to do is some of the efforts they put in place to quarantine some funds from the banks. Because if you believe, because from the perspective of central bank, they believe that inflation is driven by the volume of money supply. You're already doing much. They changed asymmetric corridor from plus 100 minus 700 to plus 100 minus 300. That's a step in the right direction. You already changed your CRR, even though the banks are having it tough, You know, we have
Yeah,
also
that's
we have also
serious for the
stifled
banks. Yes.
business in
Yes.
that segment. They're having it tough. But those are some of the quick wins that you can apply. But any other move to continue to raise interest rate at the pace the government, the central bank is doing right now, it is dangerous for fiscal stability. It is dangerous for financial system stability, because this thing also has implication on asset prices. As you are raising prices, some of these banks you are regulating, some of them have piled up assets at lower yields, and interest rates are going higher. So balance sheet size is shrinking. You see what I mean? So you can actually create on everything. So an economy is a complex machine.
Yeah.
That when you are taking a decision, you need to be looking at what are the implications of this decision that I'm about to take. You know, there is this adage that says that you can't cut off a hair to fix headache.
Yes.
If you cut off somebody's head to fix headache, the person is
Person
dead.
is dead.
So there's a level that you will apply in trying to fix a problem in an economy that you can actually terminate that economy without you knowing. So a lot of caution is advised. I think we can leave it there.
We can leave it there. It's an interesting conversation, I must tell you, and the whole hour of the show we can continue with this. But that's our time. Thank you so much, Chief Investment Officer, Afri-Invest West Africa. In one line, how is it like? We're talking about investments at this time. How is it looking like?
Well, it's fascinating for investors. You know, higher interest rate.
Yeah.
You know, it's interesting.
It's interesting
So
for
you can
them.
get more money.
Yeah.
For your investment. You know, if you delay your gratification for
Yeah.
the immediate into the future, then you get. And I dare say that this is the best time to invest because you're looking at higher interest rate. I don't know that government can sustain higher interest rate for long. You know, it can't be sustained for long because of the consequences on the economy. So if you have the opportunity, pile up assets now at higher yields so that when the rates are dropping, you are smiling to the bank.
I must thank you so much, Mr. Robert Omotunde, Chief Investment Officer, Afri-Invest West Africa. Thanks for your brilliant submissions on this topic of discourse.
Thank you
I
very
appreciate
much.
you.
Thank you.
All right, then next on the show, we'll look